The sea of red is everywhere. Apple, Nvidia, Microsoft, the titans that carried your portfolio to all-time highs, are suddenly stumbling. If you've looked at your brokerage account this week, you've probably felt that pit in your stomach. The Magnificent Seven aren't looking so magnificent anymore. But what if I told you that this crash is actually the best thing to happen to your wealth in years? What if this slide isn't the beginning of the end, but the start of a massive, once-in-a-decade opportunity for the patient investor? Today, we're breaking down why the big tech sell-off is exactly what your portfolio needs to survive the next 5 years. Stay tuned. Before we dive into the data, a quick reminder, I am not a financial advisor. This video is for entertainment and educational purposes only. Investing involves risk, and you should always do your own research or consult with a professional before making any financial decisions. For the past 18 months, the stock market has had a concentration problem. A handful of tech giants were responsible for almost all of the market's gains. While that's great when they're going up, it creates a fragile market. If Nvidia sneezes, the whole S&P 500 catches a cold. As an investor, being that dependent on 5 or 6 companies is dangerous. The recent slide in big tech is finally breaking that fever. We are seeing a rotation, a fancy Wall Street term for money moving out of overpriced tech and into the other 493 companies that have been ignored for too long. Let's look at the numbers. Many of these tech stocks were trading at valuations that assumed they would grow perfectly forever. But as interest rates stay higher for longer and AI spending starts to face scrutiny, the hype premium is evaporating. According to recent analysis from MarketWatch, this slide is healthy. It's bringing prices back down to earth where they actually make sense. For you, as an investor, this means you're no longer forced to buy the top. The market is offering a reset button, allowing you to pick up shares of world-class companies at prices that aren't inflated by pure euphoria. The best thing about this tech slide? It's shining a light on the hidden gems. While the Nasdaq was sliding, sectors like small caps, value stocks, and even utilities have started to catch a bid. For a long time, investors felt like they had to own tech or they'd get left behind. Now, the playing field is leveling. This shift reduces your sequence of returns risk. By spreading the gains across different sectors, your portfolio becomes a tank instead of a glass house. If tech stays flat for a year, your other holdings can now pick up the slack. So what should you do? Market pullbacks like this are the entry fees for long-term wealth. History shows that when the market broadens out, meaning more stocks participate in the rally, the bull market actually lasts longer. If you're a long-term investor, you shouldn't fear the tech slide. You should embrace the stability it's bringing back to the broader economy. It's moving us away from a bubble mentality and back to a fundamentals mentality. The big tech giants aren't going away, but their reign of absolute dominance needed a reality check. This slide is that check. It's making the market safer, cheaper, and more balanced for everyone. But I want to hear from you. Are you buying this dip in tech? Or are you moving your money into small caps and value stocks? Let me know in the comments below. If you found this breakdown helpful, drop a like and subscribe to the Daily Stock Drop for your daily dose of market clarity. Thanks for watching, and I'll see you in the next one.